Hi everybody, welcome to our series of video lectures on Chapter 11, Corporate Reporting and Analysis. A corporation is an entity created by law. It has legal existence separate from the owners. It has rights and privileges. Ownership of a corporation can be privately held or can be publicly held. Publicly held corporation is one that is traded on the stock market. There are some advantages and disadvantages of a corporation. Some of the advantages include separate legal entity from its owners. The owners have limited liability. Owners of a corporation are not normally found to be liable for the debts of the corporation or for the actions of the corporation. Ownership rights can be transferred. A stockholder is free to sell their shares of stock. And continuous life, meaning that the corporation will continue its existence if a shareholder either terminates its relationship with the corporation or if a shareholder dies. It does not terminate the business of the corporation. Some of the disadvantages, corporations have a lot of governmental regulations, and also a corporation is a business entity that must pay its tax on its own income, unlike a sole proprietorship or a share or a partnership where the owners of the business pay the income tax on the profits of the business. A corporation pays income tax on its own profits. Stockholders have rights. Common stockholders generally can vote at stockholders' meetings. They can sell their stock. They can purchase additional shares of stock. They can participate in dividends that are paid, if any. Corporation is not required to pay dividends, but if they pay dividends, then common and preferred shareholders can participate in those dividends. And the shareholders have a right to a share in any assets remaining after creditors are paid in a corporate liquidation. Unlike bonds, which represent debt of the corporation, stock represents ownership of the corporation. When stock is sold, the corporation is selling an ownership right. Bonds are liabilities, stock is equity. Investors who buy corporation stock sometimes receive a stock certificate as proof of their ownership. Many corporations issue only one certificate for each block of stock sold. A certificate can be any number of shares. This slide shows a stock certificate of the Green Bay Packers. A certificate shows the company's name, stockholder's name, number of shares, and other crucial information. Issuance of certificates is becoming less common. There's some important information on this slide, so we're going to take a little time with it. Before a corporation is created, the organizers of the corporation should consult with a good corporate attorney to write up a corporate charter, also sometimes referred to as articles of incorporation. This is an exceedingly important document. It clarifies many legal issues of the corporation's organization, including how many shares of stock the corporation is authorized to issue and whether that stock has a par value. Here are some very important definitions. Capital stock is a phrase for any shares issued to obtain capital, and capital is owner financing, not debt financing, but owner financing. Authorized stock is the number of shares that a corporation's charter allows it to sell. Selling or issuing stock. The corporation can sell stock directly or indirectly. Issued stock is the amount of stock which has been sold to stockholders. Outstanding stock refers to issued stock that is still held by stockholders. No formal journal entry is required for stock authorization. A corporation must disclose the number of shares authorized either in the equity section of its balance sheet or in footnotes to the financial statement. In this example, the company is authorized by the Articles of Incorporation, is authorized to issue 250 million shares of stock. That would be common stock. And has a total of 92,556,295 shares issued and outstanding. Notice that this corporation stock has a penny par value. Low par value stocks are normal. Low par values for stock is normal in business. Also notice the math on this. 92,556,295 shares outstanding, issued and outstanding, times the penny par value equals $925,562.95, which is rounded to the nearest dollar for financial statement presentation. Let's talk a little bit about par value of stock and market value of stock. Par value is an arbitrary amount assigned to each share of stock when it is authorized in the corporate charter. Par value does not have any relationship to the market price of the stock, which is the amount that each share of stock will sell for in the open market, usually the stock market. So again, par value stock is stock that has been assigned a par value in the corporate charter. There is no restriction on the assigned par value. In many states, the par value of a stock establishes a minimum legal capital amount, which refers to the least amount that buyers of the stock must contribute to the corporation in exchange for the stock. For example, if a corporation issues 1,000 shares of $10 par value stock, the corporation's minimum legal capital would be $10,000. Market value per share is the price at which the stock is bought and sold in the stock market. Expected future earnings, dividends, growth, and other company and economic factors influence the market value. Traded stocks' market values are available daily in newspapers such as the Wall Street Journal and online. The current market value of previously issued shares, for example, the price of stocks in trades between investors, does not impact the issuing company's stockholders' equity. If the corporate charter does not specify a par value for the stock, then the stock is no par value stock. Its advantage is that it can be issued at any price without the possibility of a minimum legal capital deficiency. Stated value stock is no par value stock to which the directors assign a stated value per share. Stated value per share becomes the minimum legal capital per share. A corporation's equity, also known as shareholders' equity, stockholders' equity, or corporate equity, consists of paid in or contributed capital, That's cash and other assets received in exchange for stock, and retained earnings. As we've discussed in many prior chapters, retained earnings is the cumulative net income or loss after distributions for dividends. Well, that's all for this video. In our next video, we'll talk about journal entries necessary to record the issuance of corporate stock. See you next time.